It's December 2025, and the altcoin season that was supposed to arrive in 2024 was postponed to 2025, and now it's quietly being pushed to the next year. What matters is not the delay itself, but the collapse of belief that it will ever arrive. Altcoins used to rally on new buyers. That buyers base no longer exists. Crypto Twitter, roughly 50,000 people, represents most of the remaining altcoin native capital. These are veterans who already own altcoins, have survived previous cycles, and are already maximally exposed. They don't have enough capital to push prices higher. Retail is fragmented and undercapitalized. The only actors capable of moving prices meaningfully are institutions, funds, and wealthy individuals. They draw the chart, and they are not buying altcoins. Governance tokens are meme coins in disguise. Most altcoins today fall into two buckets: meme coins and governance or utility tokens. Over the past year, governance tokens have revealed themselves to be meme coins with better narratives. On paper, token holders vote. In practice, governance often fails for several reasons. Low participation. Most token holders don't vote. Voter turnout is often in the single digits. Non-binding outcomes. Even when votes pass, execution is often discretionary or delayed. Emergency powers. Core teams, foundations, or multisig retain override authority under the banner of security or urgency. Information asymmetry. Insiders control contexts, timelines, and implementation details, making governance reactive rather than directive. Legal reality. DAOs usually lack legal standing, while devcos don't. Sky is a clear example of how governance erodes in practice. Throughout 2024 and early 25, governance votes took place around major structural and risk decisions, with active debate and formal proposals. On paper, the process looked functional. In reality, key outcomes were often predetermined by core contributors or justified under urgency and security concerns. When votes conflicted with insider preferences, execution was delayed, reframed, or bypassed. In some cases, changes were implemented first and governance was asked to ratify them after. By late 2024, voter participations dropped into the low single digits. Once token holders realized their votes didn't meaningfully concern outcomes, governance became theater and engagement collapsed. MetaDAO attempts to solve the execution problem by making governance more binding and market-driven. But even perfect governance doesn't create value on its own. Institutions don't buy voting rights, they buy ownership. The DAO versus devco split. The core structural flaw in crypto is the separation between DAOs and development companies, devcos. The DAO issues the token, governs on-chain parameters, and controls the protocol treasury. It votes on upgrades, incentive, emissions, and spending, but typically doesn't employ people or own the core intellectual property. The devco, labs, employs the team, owns or controls the IP and trademarks, manages day-to-day execution, and sets long-term strategy. It raises venture capital, signs partnerships, and can be acquired independently of the DAO, even if the DAO holds a large treasury. When acquisitions happens, buyers acquire the devco, not the DAO. This has played out repeatedly. Tensor and Coinbase. Coinbase acquired the Tensor dev team and product. The token was not acquired. Token holders received no ownership premium. Padre Terminal. The product and team were acquired while the token and DAO remained disconnected from the outcome. Axelar. Circle acquired the Axelar devco. The token was not part of the deal, and the market repriced it downward accordingly. In each case, the people, IP, and future development moved. The token didn't. There is no obligation for acquirers to buy token, compensate holders, or maintain development under the DAO. The token represents governance over an increasingly empty shell. Why this applies even to Ethereum? This problem is not limited to small altcoins. It applies to Ethereum as well. Ethereum is often defended as a utility token. ETH is required to pay for computation and security. But utility is not ownership. Holding ETH doesn't guarantee a claim on future cash flow, ownership of company, control over development, and rights in an acquisition. Ethereum has no devco equity, no dividends, and no enforceable obligation to return value to token holders. As a result, ETH valuation is demand-based, not ownership-based. That makes it dependent on competition from other L1s and L2s, fee compression over time, and UX improvements abstracting fees away. Also, technological advances lowering costs. As technology improves, fees tend to fall, not rise. AI, better infrastructure, and future computing advances push execution costs down. In that world, utility tokens compete on relevance, not control. Relevance is fragile. Why institutions are not buying? Institutions do not buy vibes. They buy ownership, enforceable rights, cash flows, control over outcomes. Altcoins offer none of these. Governance tokens do not inherit revenue. Utility tokens do not inherit equity. Devcos can exit without token holders. This makes altcoins structurally unattractive to serious capital. That is why there is no altcoin season. What remains is a closed loop of insiders trading project-branded meme coins among themselves. The only way out, and why it changes everything. To revive altcoins, the link between DAO and devco must be fixed. That likely means DAO-owned IP, token holders approved over devco acquisition, revenue or equity flowing to tokens, enforceable governance with legal backing. But once that happens, token starts to look like securities. Registration, disclosures, and regulations follow. The narrative changes, the culture changes, the vibe disappears. That may create real value, but it also marks the end of crypto as it was originally imagined. And that's why crypto, at least in its current form, feels dead.